Fill Town, Rule Number 1, the simple strategy for successful investing in only 15 minutes a week. Are you ready to venture into the world of investing but fear the complexities and myths of expert help and unbeatable markets? Rule Number 1, the simple strategy for successful investing in only 15 minutes a week. By Phil Town holds the key to unlocking the art of wise investments using nothing but the internet and a few steadfast tactics. This summary gives you insights into how you can beat the market, the pitfalls of the diversify and hold approach, and the benefits of choosing companies with moats around them. Embrace your capability of making sound investment decisions by learning about the Big 5 indicators, picking the right CEOs, and understanding the significance of margins of safety.
Investing made simple. You don't need a financial expert to make smart investments. With the help of online tools and a few tricks, anyone can beat the market and make good investments. The efficient market theory, EMT, is a myth. Prices can sometimes be far above or below their real market value, and it's possible to sell or buy stocks for more or less than their price. Today, there are many online resources such as MSN Money, Yahoo Finance, CNN Money, and RUleoninvesting.com that offer valuable information and tools to investors. These sites can make investing easier, cheaper, and more accurate than ever before. With a better understanding of the market and some smart tactics, anyone can achieve great returns on their investments. The flaw in diversification. Diversify and hold is a famous investment formula, but it also has its flaws. A diversified portfolio would have had a zero return rate for 60 out of 100 years between 1905 and 2005. Instead of diversifying, investors should keep track of all their stocks and invest in fields they understand. This allows them to react quickly to save their portfolio from losses. When investors diversify, whatever happens to the market will happen to them. Moreover, mutual funds decline in value when a large amount of money is withdrawn from the market, causing investors to withdraw even more money, and values to drop even faster. It is essential to know the dynamics of all the businesses you are investing in to keep your investments safe. Smart investing in the long term. In investing, it's important to consider buying a business instead of just stocks, as it will guide you toward making careful decisions. Investing in a company you'd like to own in the long term will make you more cautious, and you'd weigh its performance, history, and management against other companies, leading to better choices. Investing in a sector within your field of interest is also wise as you'll be more knowledgeable. Additionally, investing in a business means you're essentially voting for it to continue with its work, so it's essential to be mindful of the impact your investment will have. As a rule number 1 investor, it's important to remember that investment decisions should align with your values, and you should avoid investing in companies that exploit others. Building business resilience. Companies with robust moats thrive amidst competition and inflation. Moats come in different forms, ranging from intangible competitive advantages to strong brand loyalty, cheap product prices, reduced switching costs, and legal monopolies. Such moats enable businesses to dominate market shares, charge premium prices, and expand profits to grow their enterprises. An example of an intangible competitive advantage is a patent or trade secret that keeps direct competitors at bay. Some companies rely on a strong brand that customers resonate with, while others leverage their size to offer cheaper products than competitors. Another type of moat involves offering a product that is cheap and easy to buy, or a product that is difficult to switch away from, such as Microsoft's Windows operating system. Lastly, legal privilege can create exclusive governance over a market, as with PG&E's monopoly over power provision in its area. Companies with one or more moats can generate significant returns for investors, making them a wise investment choice. A blueprint for identifying a company's moat. Successful companies have moats or distinct competitive advantages that keep competitors at bay. This summary offers a blueprint for identifying a company's moat based on 5 different indicators. Firstly, a company with a wide moat has a high return on investment capital, ROIC, over at least 10 years. A company that can maintain a ROIC of at least 10% for a decade likely has the advantage over its competitors. Secondly, a company's equity growth of 10% or more for 10 years indicates that the company has enough cash to invest in expansion. Additionally, a patent, a unique product, or a strong brand can be an indicator of a strong moat. Finally, businesses with a high switching cost or a low production cost also have a better chance of beating rivals. Understanding these indicators is crucial for investors and business owners as they help in picking profitable stocks, avoiding falling stocks, and maintaining a competitive business advantage. Calculating a company's moat. Learn how to determine a company's competitive advantage through EPS, sales, and free cash flow growth rates. When it comes to investing in companies, it's important to identify those with a competitive advantage or moat. While there are many methods to determine a company's moat, there are 3 straightforward calculations that can be used. The first calculation is based on the growth in earnings per share, EPS, over approximately 10 years. A company with at least a 10% increase in EPS for a decade is likely to have a strong moat. To calculate the rate of EPS growth, the rule of 72 can be applied. If EPS doubles 3 times over 10 years, averaging around 3 years to double each time, the result is a 24% moat. Another way to calculate a company's moat is through a consistently increasing sales growth rate of over 10%. Take Garmin, for example. Its sales grew from $100 million to around $800 million in 9 years, doubling 3 times, or once every 3 years. Applying the rule of 72, we get a 24% sales growth rate, indicating a strong moat. Finally, a consistently high free cash flow growth rate also indicates a strong moat. This is the rate at which a company's profits turn into cash, and it should be consistently over 10%. If free cash flow doubles just under twice in 7 years, or once every 3.5 to 4 years, the resulting sales rate is 18%, indicating a highly profitable company. By analyzing these growth rates, investors can determine a company's moat and competitive advantage. Opt for an owner-oriented CEO. Looking for a company to invest your money in? Look beyond the Big 5 criteria. It's crucial to consider the effectiveness of the CEO before investing in the company. A good owner-oriented CEO is one who prioritizes long-term smart decisions, informs shareholders about problems, and refrains from actions that bring temporary stock price hikes but hurt the company down the line. A driven CEO, who aims for big goals and reminds employees of them, is crucial to a company's profitability in generating company value. The example of an owner-oriented CEO like Darwin Smith, who transformed and expanded Kimberly-Clark, speaks volumes about the importance of considering the CEO's honesty and dedication to making the company an ideal investment option. Knowing the traits of an owner-oriented CEO before investing can help you make a sound estimate of a company's worth. Investing with margin of safety. The effective market theory is wrong. Buy stock when its value exceeds the price with a good margin of safety. MOS is the value minus the price. AMOS of 50% is good. In 2000, no Nasdaq stock that crashed had a stock price higher than its value. The efficient market theory, EMT, claims that the stock market is always accurate, and market fluctuations are always correct. However, EMH is wrong. The price and value of shares are not the same. Investors have an advantage if the difference between both is significant. The value of shares depends on the business's future earnings per share and price-to-earnings ratio. Although valuation is complex, online tools like sticker price calculators can help assess it. Markets are often inaccurate in the short term, like in the late 90s when the price of gold, silver, and copper dropped. Savvy investors bought the shares at low prices. In contrast, the value of these metals wouldn't decrease in the long run. Demand rose again in the early 2000s, increasing share prices and generating profits for investors. The margin of safety, MOS, is the difference between value and price. A good MOS would be half the investment's value. For instance, Dell's 2000 value was $40 per share, matching its market price. However, the MOS was zero. As a rule number one investor, the MOS should be 50% or less than the investment's real value. So, Dell's price, which fell to $20 per share a year later, became attractive with MOS reaching 50%. Investors can expect better returns if they invest with a good MOS. This rule also prevents losses in case of a market crash. The 2000 Nasdaq stock market collapse demonstrated that every stock that crashed had a stock price higher than its value. Therefore, buying shares with MOS can lead to success in the stock market.
In rule number 1, the simple strategy for successful investing in only 15 minutes a week. Phil Town equips you with the knowledge to independently and successfully make investments. By debunking the myth of expert help and an unbeatable market, it encourages you to take control of your finances. Remember that investing within your field of interest and capitalizing on wide moats around companies can yield higher returns. Assessing the Big 5 indicators and having an owner-oriented, driven CEO adds to your confidence in a company's performance. Finally, understanding stock value, gauging its difference with price, and maintaining a substantial margin of safety are key to mitigating risks and growing your investment portfolio in a steady and successful manner.